Welcome to StockTok's deep dive into Brookfield Asset Management. This is a global alternative asset manager. Think private equity, infrastructure, real estate, managing hundreds of billions of dollars on behalf of institutional and retail investors worldwide. As of May 5th, the stock is trading at $48.43. Over the past 52 weeks, the name has ranged from a low of $42.20 to a high of $64.10. That means the stock is currently trading closer to the lower end of that range. The RSI 14, which measures momentum on a scale of 0 to 100, is sitting at 58.7, right in neutral territory, neither overbought nor oversold. The 50-day moving average is at $45.91, while the 200-day moving average is at $52.33. Translation: the stock is trading above its 50-day trend but below its 200-day trend, a mixed technical picture. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Brookfield Asset Management is a specialist alternative asset manager with a global footprint. The core business model revolves around earning management fees on assets under administration. The larger the pool of capital you manage, the more fee income flows to the bottom line. The company's competitive moat rests on several factors: deep institutional relationships accumulated over decades, proprietary deal sourcing in infrastructure and real estate, and scale advantages in managing large, complex, long-duration assets. In our view, the moat is material but not impenetrable. Now let's score the setup. Brookfield Asset Management receives a StockTok score of 41 out of 100. That signals caution. Breaking it down, valuation scores a 10 out of 20, meaning the stock looks stretched relative to fundamentals. Financial health is 11 out of 20, concerns here. Profitability scores 18 out of 20, that's a strength. Growth scores 0 out of 20, essentially stalled. And smart money scores just 2 out of 20, institutions are not accumulating. Now, valuation. The question every investor has to answer: are you paying the right price? Brookfield Asset Management is trading at a price-to-earnings multiple of 31.3 times trailing 12-month earnings. For context, the asset management industry has historically traded in the range of 13 to 18 times earnings. At 31 times, this stock is commanding a significant premium. The forward price-to-earnings ratio, based on analyst estimates for the next 12 months, is 25.7 times. That's still elevated relative to peers, though less extreme than the trailing multiple. The PEG ratio, which is the price-to-earnings ratio divided by the growth rate, is showing 0.00. This is a critical red flag. A PEG above 2 suggests a stock is expensive relative to its growth trajectory. Here, with essentially flat growth, the PEG is essentially meaningless in the positive sense. You are paying a premium multiple for an asset that is not growing. The enterprise value to EBITDA multiple sits at 25.05 times. Again, this is elevated. The price-to-sales ratio is 16.57 times. Asset managers typically trade between 0.5 and 2.0 times sales. At 16.57 times, the valuation suggests either the market is pricing in extraordinary future profit margin expansion, or the stock is simply stretched. Our DCF analysis suggests the stock is trading at approximately 0% margin of safety. In other words, at fair value to intrinsic value according to our model, with no margin for error. Wall Street analysts, however, have a different view. The consensus mean price target across 18 analysts is $57. The high target is $74. The low is $44. That spread from 44 to 74 tells you there is meaningful disagreement on what this stock is worth. The $57 consensus target implies roughly 18% upside from current levels, assuming the estimate proves accurate. Let's examine the latest earnings to understand whether the momentum justifies the premium. In the most recent quarter, Q2 2025, Brookfield Asset Management reported earnings per share of 0.40 cents, missing the consensus estimate of 0.41 cents. Revenue came in at $1.24 billion, falling significantly short of the estimate of $4.82 billion. That is a substantial miss. Revenue growth year-over-year was 8.4%. Operating income was $0.95 billion, with net income of $0.56 billion. The stock fell 0.6% after these results were announced. The miss raises questions about execution and forecast accuracy. The revenue shortfall is particularly notable. It suggests either one-time items in the estimate or a divergence between expected and actual asset flows or market conditions. On the positive side, the company still delivered net income of $0.56 billion, demonstrating underlying profitability despite the top-line miss. Upcoming earnings are expected on May 8, 2026. The consensus earnings per share estimate is 0.42 cents, with a range from 0.39 to 0.45 cents. This will be a near-term catalyst to monitor. From a peer comparison standpoint, Brookfield Asset Management's valuation multiples exceed those of larger global competitors such as Apollo Global Management and Blackstone. Those firms trade closer to 13 to 16 times earnings. The premium here does not appear justified by superior growth or margin profiles. In our view, market sentiment around Brookfield Asset Management leans bullish as of this analysis. That optimism appears driven by favorable conditions in the broader alternative asset class, strong and activity in healthcare, enterprise AI adoption, and infrastructure investment themes, rather than by company-specific catalysts. In our assessment, valuation presents a meaningful headwind. The stock appears fairly valued to slightly expensive relative to intrinsic value, and growth does not justify the multiple being paid. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point checklist that evaluates balance sheet quality and operational health. Brookfield Asset Management scores a 4 out of 9. This is below the 5-point midpoint and suggests some deterioration in financial quality. A low F-score often points to declining profitability, rising leverage, or deteriorating working capital. In other words, the business is showing some stress signals. The Altman Z score, which is a model that predicts bankruptcy risk on a scale from 0 to 10, comes in at 8.08. That is well into the safe zone. Anything above 5.9 is considered safe from bankruptcy. So despite the weaker F-score, the company's overall solvency is solid. Now let's examine the balance sheet in detail. The cash-to-debt ratio is 0.44. This means for every dollar of debt, the company has 44 cents of cash. In the asset management industry, this is not alarming. Many firms carry more leverage than traditional manufacturers or retailers, but it does signal moderate leverage. The debt-to-equity ratio is 0.45, which means debt is less than half of equity. Again, this is manageable but shows the company is not running a fortress balance sheet. Interest coverage is 9.47 times. The company's operating income covers its annual interest expense roughly 9.5 times over. That provides a reasonable cushion, though not exceptional. The current ratio, current assets divided by current liabilities, is 3.45. This is strong. Any ratio above 1.5 is considered healthy, and Brookfield Asset Management is well above that mark. In summary, the balance sheet is adequate but not exceptional. The company can service its debt obligations without stress, yet the low Piotroski F-score hints at operational headwinds that warrant attention. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, measures how much profit the company generates for every dollar of capital it deploys. Brookfield Asset Management's return on invested capital is 19.6%. That is strong. For context, the cost of capital for a global financial services firm typically ranges from 7 to 10%. A 19.6% return on invested capital means the company is generating returns well above its cost of capital, which is a hallmark of a quality business. That is a genuine competitive advantage. Gross margin, the percentage of revenue left after direct costs of delivering services, is 70.27%. For an asset manager, this is normal. The company is not manufacturing widgets. It is selling expertise and market access, which carry naturally high gross margins. Operating margin, earnings before taxes and interest, expressed as a percentage of revenue, is 65.9%. This is exceptional. Most financial services firms run operating margins between 20 and 40%. At 65.9%, Brookfield Asset Management is demonstrating pricing power and operational leverage. Net margin, net income expressed as a percentage of revenue, is 53.93%. This is outstanding. The company is converting more than half of every revenue dollar into bottom-line profit. This profitability profile is genuinely impressive and explains why the market is willing to pay a premium multiple. Free cash flow margin, the percentage of revenue converted into cash the company can return to shareholders or reinvest, is 48.72%. This tells us that profitability is not just accounting earnings. It translates into real cash. In the most recent quarter, these margins remained robust, underscoring the sustainable nature of the business model. In our view, profitability is the strongest dimension of this investment. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years is 0.00%. Revenue growth over the trailing 5 years is also 0.00%. This is stark. The company is completely flat on a revenue basis over both periods. This is not stagnation. It is outright contraction or extreme volatility masking no underlying growth. For an alternative asset manager in a period of record capital inflows into the alternative space, flat revenue is disappointing. One might argue that flat revenue could reflect market downturns affecting fees, but the lack of growth even over a 5-year period suggests structural challenges in winning new mandates or scaling existing ones. In the most recent quarter, revenue growth was 8.4% year-over-year. That represents an uptick, but given the 5-year zero growth backdrop, this could be a cyclical bounce rather than evidence of a sustainable growth reacceleration. Book value growth, the value of shareholder equity per share, has declined 5.2% over 3 years. This is concerning. When a quality business is growing and retaining earnings, book value should expand. Here, book value is shrinking, which suggests either losses, dividends exceeding earnings, or unfavorable revaluations of assets. The dividend yield is 3.78%. For an asset manager, this yield is solid, but it reflects the company returning capital via dividends rather than reinvesting for growth. The dividend policy may be masking the lack of internal growth momentum. In our view, growth is the Achilles heel of this investment. The business is profitable and cash generative, but it is not expanding. This is a mature, potentially consolidating industry, and Brookfield Asset Management appears to be losing ground relative to larger, more specialized competitors. Now let's talk smart money. What institutional capital is actually doing with this name? 9 top-tier investment gurus currently hold Brookfield Asset Management in their portfolios. Thomas Gaynor, the chief investment officer of Markel Group, owns the stock as approximately 0.82% of his portfolio. No change in his position over the recent period suggests he views it as a hold, not a buy. Only 3.5% of institutional filers tracked by 13F filings. Those are quarterly disclosures of equity holdings by fund managers with more than $100 million in assets, are net buyers, meaning they increased their positions over the most recent quarter. For context, anything above 50% would signal net institutional bullishness. At 3.5%, this is deeply bearish sentiment. The vast majority of institutional shareholders are either holding steady or trimming positions. Insider ownership is 0.00%. This is a major red flag. When management owns virtually none of the company they run, there is a misalignment of incentives. The founder and executives have no economic stake in long-term value creation. Over the past 3 months, there were 0 insider buys and 0 insider sells. The complete absence of insider transaction activity, combined with 0 insider ownership, suggests a disconnect between management and shareholders. In our assessment, smart money sentiment on Brookfield Asset Management is extremely weak. The fact that only 3.5% of institutional filers are buyers, combined with zero insider ownership and no insider buying despite a stock that has declined from its 52-week highs, sends a clear message that informed capital is not accumulating. This is a significant contrarian signal. And finally, the verdict. Let's bring it all together. On valuation, the stock is trading at a 31 times earnings multiple with a PEG ratio of 0 on 0% growth. This appears stretched relative to peers and relative to intrinsic value. The Wall Street consensus price target of $57 implies upside, but consensus is frequently wrong, particularly at cyclical peaks. On financial strength, the balance sheet is adequate but not fortress-like. The Piotroski F-score of 4 suggests some deterioration in quality, though bankruptcy risk is low. This is a company that can service its obligations, but may face tightening financial conditions if growth remains stalled. On profitability, this is the standout. Return on invested capital of 19.6%, operating margins of 65.9%, and net margins of 53.93% are genuinely impressive. The business model at its core is highly profitable and efficient. On growth, this is the critical weakness. Zero revenue growth over 5 years, flat book value growth over 3 years, and minimal institutional buying are all red flags. The company is not expanding in an industry that should be experiencing secular tailwinds. The most recent quarter showed 8.4% revenue growth, but this appears cyclical rather than structural. On smart money, only 3.5% of institutional filers are buyers, insiders own 0% of the company, and top gurus have shown no recent buying. This is one of the weakest smart money signals we track. The latest earnings results, a miss on both earnings per share and revenue, did not spark confidence. The company delivered 0.40 cents per share versus a 0.41 cents estimate, and revenue of $1.24 billion fell short of $4.82 billion expected. The market's tepid reaction, a 0.6% decline after hours, suggests investors are cautious but not panicking. In our view, Brookfield Asset Management presents a classic value trap setup. It is profitable and well managed, but it is pricing in growth that is not materializing and faces structural headwinds in an increasingly competitive market for alternative assets. For investors seeking growth, the 0% growth profile is disqualifying. For value investors, the 31 times earnings multiple is not cheap enough to compensate for the lack of momentum. A more attractive entry point would be in the low 40s, below the 200-day moving average, where valuation would begin to offer a margin of safety. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Brookfield Asset Management. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.